Hello, and how is it going, ladies and gentlemen? I am Palosh, and in this video we'll be analyzing 3 incredible companies that pay a good dividend, and that any investor looking for some healthy returns should consider adding them to their portfolio. Dividends are a way for a business to return value to their shareholders, not a sign of a mature and stable company. The fact that the cash used to pay the dividend is not used to expand the business is usually a sign of a somewhat limited growth. But it shows stability, and it's a more certain way of getting a return on your investment, as Kevin O'Leary best put it.
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company, I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked. It's just a rotating door where management extracts capital, never returns any to shareholders. And I look at that and say to myself, why don't I just avoid that altogether? If it doesn't pay a dividend, I know that 71% of the time all the returns come from dividends. Why should I own a stock that doesn't pay a dividend? And I never will.
So, let's get right into it. The first company we will be analyzing today is Bank of America, ticker BAC. Bank of America being one of the largest financial institutions in the US, with a valuation of around $216 billion and with more than $2.3 trillion in assets. It's organized into 4 major segments, consumer banking being the largest one, and global wealth and investment management, global banking, and global markets. Now let's look at the financials. We can see that in the past 4 years the total revenues have increased from about $84 billion to $91 billion. The company being a bank, it's a pretty substantial increase, and it's a very good and healthy sign. Looking at the net income is where we see a pleasant surprise. The income's rising from about $18 billion to $27 billion, which is almost a 50% increase, which made the earnings per share grow from $1.50 per share to $2.75. If we compare it to the competition, we can see that it looks even better when we look at Wells Fargo, which had a revenue of $87 billion in 2016 and a revenue of $85 billion in 2019. If you look at the incomes, the story is not better. $22 billion in 2016 and $19 billion in 2019. So we can see that Bank of America is doing pretty well compared to the competition when it comes to revenues and income. If you look at the PE ratio, we can see it has a PE ratio of 12, which is very low compared to the S&P 500, which has a PE ratio of about 21. But it is a bank, and if we compare it to the other banks like JP Morgan and Chase, which has a PE ratio of 13, we can see it's a bit more similar, but it is much better than the PE ratio of Wells Fargo, which is 26. Looking at the price to book value, we can see that 0.9, and it being below 1, that means the stock is, looking at just this indicator, slightly undervalued. The profit margins are very healthy, 26%, which is better than JP Morgan and Chase's 25%. And much better than Wells Fargo's 9%. If you look at the return on equity, it stands at 7.56%, which is not amazing. It is worse than the 9.53% of JP Morgan and Chase, but it is much better than the 3% of Wells Fargo. Looking at the debt, we have a debt of $500 billion, but because this is a bank, it's nothing to worry about. That's what banks do. They have to take on debt to lend money to people. Looking at the dividend, it has a dividend of 2.87%, paying 0.72 cents a share per year. That's lower than JP Morgan and Chase's 3.7%. But the payout ratio is much better. JP Morgan and Chase has a payout ratio of 50%, and Bank of America has a payout ratio of 35%. Excuse me. That is much better and has a lot more room to grow in the future. And as we can see, in the last 10 years, the dividend has been growing from a cent a share to 18 cents a share, which is a huge increase, but that is because the dividends were heavily slashed in the 2008 financial crisis. One very important thing to look out for is that Berkshire Hathaway owns 11.5% of Bank of America. Before the pandemic, Warren Buffett had a stake of 10.7% in the company and decided to buy even more shares now, while selling companies such as Wells Fargo, JP Morgan & Chase, and Goldman Sachs. I think that's a very good sign that the Bank of America is a very strong business, and in my opinion, at the current price of $25, it is a buy up and has quite a good potential for the upside, especially in the long term. The next company I want to be talking about is Microsoft, another company that I'm sure everybody has heard about, and even most people have used their products. It is a huge company with a market capitalization of $1.6 trillion, the second largest company in the world. And you might ask, well, why is it on this list? If it only pays a 1% dividend and it has such a high PE ratio, why would I even consider investing in this company? Well, because of the growth it can provide in its share price and in its dividend. It is a huge company that has been growing in the last 5 years incredibly quickly, quadrupling its price in the last 4 years. If you look at the financials, you can see that all that growth is backed up by the financials. In 2017, it had a revenue of $90 billion, and in 2020 it grew to $143 billion. That's almost a 50%, well, it's more than a 50% increase in revenue. If you look at the income, the story gets even better, because in 2017 they made $21 billion, and 2020 it more than doubled to $44 billion. So the numbers are looking great for this company, and that's why it's so highly valued, because of the growth that it can provide. Looking at the other metrics, we know that the PE ratio is huge, and the price to book value is bound to be very high, but the profit margin is 31%. That's very healthy. That means they have a lot of wiggle room. And the return on equity is 40%, which is incredible. That is amazing. You don't see such high numbers in every company. We will always look at the dividend and see that it is paying 1% dividend, that's $2 a share per year, which is pretty low. But as I said with Bank of America, the payout ratio is 35%, which is pretty low. They have a lot of room to grow their dividend, and not only that, they have a lot of room to grow their company, which can make the dividend grow quite substantially in the future. The very high PE ratio of the company makes it harder to value, but we can see that with such a huge growth, and the company being so dedicated to growing their business by trying to purchase TikTok, or by getting itself in the mobile phone business, are great ways to improve revenues and return value to their shareholders, eventually increasing the dividend, and the share price will increase also. If you've made it to this point of the video, make sure to leave a like or subscribe, or both. Thank you. The last company we will be looking at today is going to be AT&T, the largest telecommunications company in the United States of America, with a market cap of $211 billion. It has a PE ratio of 18, which is pretty reasonable, and it pays a huge dividend of 7%, that is $2.08 a share per year. Looking at the financials, we can see that it has been growing its revenue for the past 4 years from $163 billion to $181 billion. This is not a huge increase, but it should be expected from a company that pays such a huge dividend. The net income and earnings per share have been very inconsistent, but average at around 2.5 or $3 per share per year. If we look at more metrics, we can see that the company has a profit margin of 7%, which is expected with telecommunications company, and a return on equity of about 7%, which is not great. Looking at the dividend, as I said, it's a 7%, and even though here it says 126% payout ratio, I think that's for the last quarter. If we look for the last 12 months, it has been 58%, and the estimates are about 65 to 63% payout ratio. The reason I really like AT&T at this price is not only because of its amazing 7% dividend yield, but also because of its 5G network and the Warner Media segment, which owns HBO Max and has a lot of room to grow, adding to the revenues and the stock price and eventually the dividend. Now, ladies and gentlemen, make sure you do your own due diligence before investing in the stock market. I hope my analysis helped you in picking out those stocks for your portfolio, but I'm not a financial expert. Take care now, I'll catch you in the next video.